Thank you very much once again for everyone being here. For those who don't know me personally, I'm one of the IFAs at Acumen. So I've worked here for a good few years now, but I've been around the company since I was a little boy, because I don't know whether sort of everyone will know, but Angela's my mum. Acumen's a bit of a family business in that sense. So I've been around the company since since it started really, as a little boy, and been with the Acumen every step of the way really. So like I said, so thank you very much for coming tonight. In terms of myself, what we were trying to do with the evening today is basically warm up the conversations. So whether you're a corporate partner of ours, whether you're a client, sort of present to you what alternative investments there are out there, what they do, why they do them, why we're even talking about them, and essentially sort of get those conversations started. So when you're sitting across from your advisor, maybe in an annual review meeting, you have that sort of already queued up in your mind. And when the advisor suggests, hey, well, maybe we do something a little bit different to the traditional things, maybe on the side, a bit of an alternative. You already know who it is and what it is that we're talking about. So that's the purpose of the evening tonight. So just to give a little bit of an overview of ourselves, I'm sure many of you will be aware of who Acumen are, but we were established in 2006. So we've been here quite a while, but prior to our actual creation as Acumen, the forming of the partnership that we are now, almost all of our advisors started in the industry and have years of experience that have sort of brought that wealth experience to the table. And then, following on from that, we have quite a homegrown, that's what we like to call it, a homegrown sort of ethos within the company of starting from scratch. So like myself, joined as an apprentice and worked all the way up to now being fully qualified and the firm's first fellow. So it's one of those things where not only do we recruit from really strong backgrounds with years of experience, but we also nurture from within, build that team from within. And that's really led us to the point we are today, the size that we are, looking after £375 million worth of client funds. Now, obviously, volatility in the market at the moment, that figure changes on a day-to-day basis, but we're in that region there or thereabouts. So, like I said earlier when I started, why are we here? Why have we gathered, everyone here tonight? Well, obviously, as Angela suggested, it's nice to have everyone in a room. It's nice to sort of have a bit of a meet-up, maybe a bit of a network. But equally, what are the challenges we're facing at the moment in the sort of legislative, the fiscal markets? It's not just about the investment. When we do the financial planning, it's holistic. It's everything that goes into that parcel. And it's been inescapable, the recent budget updates, personal tax allowance freezes, the pension allowance freezes, inheritance tax allowance freezes. One of those things that it's a bit of a shadow tax really, because what you might have heard it described as before is fiscal drag. It's the idea that as salaries go up, the same allowances are given to clients each year, given to people each year. But as salaries go up, more and more of that money creeps into either the higher rate, the additional rate. More and more people are finding themselves, very normal people with accumulating increasing house prices. Very normal people are seeing inheritance tax liabilities forming. So, what can we do about that? That's exactly what we're here to sort of look at. What ways can we look to mitigate those liabilities and create a very strong portfolio as a result of doing so? We're not looking to sacrifice quality for the sake of tax planning. There's a phrase in the industry, don't let the tax tail wag the investment dog. And that's something that, it's really important that we don't let those financial planning objectives necessarily dictate what we do and reduce the quality. So obviously tonight it's to warm up those conversations, introduce our partners, show the level of expertise that we've got around the table and how we can really help in that sense. So the topics for conversation this evening, things that you might hear. We've got I'll sort of go into this in a little bit further detail shortly, but we've got enterprise investment schemes, venture capital trusts, alternative investment markets, and business property relief. There's something that you will, probably hear quite regularly this evening. So when you hear those terms, when you hear enterprise investment scheme, when you hear alternative investment market, what should you think? What sort of thoughts should it bring to mind? I think that's the easiest way for me, at least, how I learn that, get that real core sort of those thoughts out of the way first. So when you hear EIS, when you hear enterprise investment schemes, typically what that sort of triggers in my head is growth. That's typically they're growth-focused investments, maybe early-stage companies, and that's what they're really going to be designed to produce for clients is growth. Now, venture capital trust, other side of the spectrum. So it's not necessarily growth. Doesn't mean you can't find growth in these markets, but it's usually, if you think income. So if you hear venture capital trust or VCT, think income. In terms of the alternative investment market. Now, in the UK, we have 2 listed stock exchanges, one being the FTSE and 2 being the AIM. Now, the AIM is typically smaller companies. They're seen as sort of earlier stage. The requirements to list on the AIM market are slightly lower than typical full listings that you'll find on the FTSE. So what that means is that, the government likes to encourage investment into these areas. As I said, they're early stages, nurture that the British industries, really provide support to those companies. So they give some tax advantages to doing so, but also with that sort of smaller cap, that smaller size company, you do see, a higher potential for growth in these markets. And finally, if we just look at business property relief, I said, typically speaking, there's many ways you can look at this, but typically speaking, you are considering sort of capital preservation. So what I mean by capital preservation, because that's quite maybe a topical thing, but capital preservation really is, you're not looking to shoot the lights out with returns. You're not looking to, get 10% year on year in growth. You're looking to sort of maintain a sort of a very, very close to index linking, very close to keeping up with inflation. But equally, the biggest sort of thing, as we mentioned in the earlier slides, that you have as an issue at the moment is taxation. So capital preservation for BPR, that's where you essentially have very tax advantageous structures set up for clients, whereby they can avoid things like inheritance tax. So that capital preservation is core. So it's not only is it sort of throughout your life retaining control over the capital, keeping up with inflation, not looking necessarily to outpace it, but it's also on death, making sure all of your assets go to your children, go to your family members, go to the people that you would like them to inherit in full. So, as mentioned, first off, enterprise investment schemes. So, like I said, when you hear this, think growth. So it's early stage companies. Now, what they say is sort of where there's greater risk, there's greater chance of reward. And you have these early stage companies, they're typically brand new ideas, maybe groundbreaking, trail-breaking companies that are, hopefully some of them going to change at least the country, if not the world. And what you find is when you get in at those early stages, the potential for growth, there's almost no ceiling. Sort of early days of, let's just say for the sake of argument, you've got Microsoft back when it first listed, between the point of listing and now you've sort of got, 130,000% returns. So really, you've got, these early stage, when you start out those small companies, you have a potential really high ceiling before you sort of look to max out on that. So high growth, high risk, high reward type thing. So as a result, the government gives a 30% tax credit. Now, what this is really good for, this and VCTs, but we'll come back onto that. 30% tax credit is essentially a 30% refund of income tax. So very similar to paying into a pension. When you pay in, you get, let's say you have an income tax liability, you can really mitigate that, really bring that down, and then have the potential for growth as well. So what you've got on one side of the coin is a potentially really lucrative investment opportunity, but equally you're bringing your tax liabilities down as well. and then any capital gains found on those companies in a portfolio, these EIS investments, would be tax-free. But the key thing to remember with this sort of investment is that with private equity, there are minimum hold periods. You have to hold them for at least 3 years to retain that tax relief. You can't, get the money back and then immediately pull the money out of the company. There has to be some sort of tie-in period, some investment, properly investment into the company, not just trading. It's, it's really getting on board with the story, getting on board with the company, and sort of supporting it in its journey. VCTs, now venture capital trusts, once again, when you hear this, maybe think more income focused. So VCTs typically are similar to pooled investments. So you'll have, you'll buy units in essentially a fund. Similar thing, they're unlisted companies, so private companies. And what you find is that you have a greater level of diversification, but they're because you're buying in a fund, you sort of go in quicker because the fund's already established and potentially has a long track record. But what they're designed to do is roll up any potential growth and income and create a dividend stream which is tax-free. So not only do you get your 30% tax credit similar to the EIS, not only can you use it to bring your income tax down, but you can also benefit from typically it's a 4 to 5% dividend yield tax-free, which when you sort of structure over a long period of time, build up maybe a sizable holding, quite quickly that 5% can become something really powerful. And let's say you're a higher or additional rate taxpayer, say a 5% tax-free dividend. If you were to get that from earned income that you were going to pay tax on, you effectively have to double that figure. So it's almost worth twice as much to a higher or additional rate taxpayer. So that's really important. But once again, there's a minimum hold period. So you've got to remember that this isn't a trading exercise. This is a proper investment. You're sort of getting in on day one. You're sticking with the program for, in VCT cases, 5 years. The alternative investment market. So once again, that's a sort of growth-focused investment. So you've got this sort of asymmetrical relationship with the growth. You have sort of your capital invested, and the potential for returns are typically quite high. Now, obviously, where there is higher return, there's potentially higher risk, and that's why they give you the various tax advantages of AIM portfolios that you typically get. So what you'll find with AIM is that after 2 years, they're free from inheritance tax. So whilst they do provide a growth-focused element to a portfolio, being free from inheritance tax, they also tie in with that idea of capital preservation. So after 2 years, you can pass them on to your sort of descendants, free of inheritance tax, so you don't have to worry about that 40% hit. Now, there's one way you can think about it in this respect. I'm not sure whether I'm fully on board with this idea, but there is one way. The idea being that these investments, AIM and the like, are potentially high risk, okay? So you have the potential that in current market climates, you have, a lot of volatility. Now, what you've got to trade off is that if you've got somebody that's potentially definitely going to get an inheritance tax charge of 40% at some point in their life, and in order to help mitigate that, you can take on a little bit more volatility than you would in the normal markets, but what you'll have is you'll mitigate that 40% tax hit on death entirely. The idea being really is what's worse, higher volatility or a guaranteed 40% drop in the value, because that's essentially what's going to happen eventually. And as they say, the whole death and taxes being the only two certainties, unfortunately, that inheritance tax, all the government have to do is sit on their hands and wait. And ultimately, having something that provides a little bit of potential for, well, not a little bit, sorry, a lot of potential for growth, but also looks to mitigate inheritance tax, that could be a really powerful thing. We'll go into how you can combine it and the like, but I'll explain that later. Finally, just going on to business property relief. So as mentioned earlier, sort of capital preservation focus. So something that's not looking to shoot the lights out, not looking to outperform markets, just looking to reduce that, that liability to inheritance tax. So remove that 40% hit on death and typically yield 3 to 4%. And what we've found is that with a lot of these business property relief funds and the way they're structured is they're very inflation proofed. So what you'll find is that typically they are sort of infrastructure funds. They might be involved in sort of renewable energy. I'm not going to go too far into that. I think Colin will sort of maybe explain that later. But essentially, all of those things that are impacted by inflation essentially become more profitable in periods of higher inflation, and therefore the yields also increase. So what you'll find is that even in a high inflation environment, you might see a return that keeps on par with that, and that's really what they're designed to do. It's to reduce that inheritance tax liability as much as possible, but also provide a relatively nominal return in comparison. Now, I understand there was a lot sort of to digest there, but I'm going to go into the idea of a barbell strategy. Now, this is something that's resonated quite personally with me because I don't know whether some of you may not be aware, but at one point in time I was lifting quite competitively. So the idea of a barbell sort of resonates quite strongly with myself. Essentially, it's the idea that something that you will come across, you will certainly be impacted by at some point in your life, and anyone that's a client will have sort of experienced this, even if they don't know it directly, is the idea of what's called efficient market hypothesis, and also sort of modern portfolio theory. And what that really means is the idea that when you have a portfolio of assets, the best way to mitigate risk is to diversify across a number of different markets, a number of different asset classes. So everyone that's got sort of a pension portfolio with ourselves, everyone that's got any sort of investments, even if it's a workplace scheme, typically will have a portfolio constructed in that sense. So you'll have stuff ranging from really high risk, maybe sort of tech stocks in that portfolio, all the way down to, say, government bonds. And that's typically seen as an industry that's the best way of mitigating risk. Well, that's all well and good when it comes to portfolios where you don't have to really limit what opportunities for investment are out there, because you're not looking to solve any of those tax issues that we talked about. But when you are effectively limited to what you can invest in because you're trying to mitigate an inheritance tax liability, you're trying to bring your income tax bill down, you are actually limited to what you can construct a portfolio with. So a barbell is quite a good metaphor for this. So I don't know how clear that is, but essentially you've got on one side of the barbell, you've got hyper-conservative investments. So that's stuff that almost guaranteed not to lose any value. They'll keep pacing with inflation. This might be sort of, the BPR products that we've talked about. This might be government bonds, NS&I, cash management tools, sort of things that are going to provide a small yield. They're not going to shoot the lights out. They're not going to lose any value. They're pretty much government-backed or huge inflation-proofed products like the sort of BPR funds that you'll find. Then, rather than having sort of different stages of risk in the middle, you have, as the sort of metaphor suggests, nothing, i.e. the barbell, and then at the other end, you have the hyper-aggressive, you have the EIS, you have the VCT, you have the AIM. So when you sort of hear about what I've talked about here and what's going to go on, to be talked about later on in the evening, you might think, well, that sounds really good, but naturally I'm quite a cautious person. I'd like to do that, but I don't really know how I can fit that in with my particular situation. Well, first off, that's sort of the financial plan. That's where we can come into it. So talk to your financial advisor, and this is a way in which we can structure it for you. This is one of the many ideas that we can sort of go down the route of, where essentially you combine, let's say, a business property relief investment, something that's going to provide a small yield, and then on one side of the barbell have something that's going to provide the potential for growth. Because when you think about it in that sense, you've got something that has a potential for very large gains, you know, that can provide a real return long term, but you're not risking all of your capital. You're not going fully in the deep end. You're blending them quite nicely. And you know, what you'll typically find is we could maybe do 80%, i.e. the heavier side of the barbell, 80% say would be in something more guaranteed, with the smaller exposure on the other side of the barbell that's a little bit more spicy, should we say. So that's pretty much you know, it from me.